Traditional sector-based investing is becoming obsolete. What's driving company profits today isn't simply tech or utilities. It's control over bottlenecks. In this video, I'll walk you through exactly what bottlenecks are, where the most important ones are forming across AI, climate change, and urbanization, and how to position your portfolio to profit from them. Now, saying sector-based investing is obsolete might sound like a bold claim, but think about it this way. When you buy into tech, utilities, or real estate, you're working from a map that was drawn for the last economic cycle, not the next one. And the next one is being shaped by three powerful forces, all at the same time: artificial intelligence, climate change, and urbanization. Here's a quick thought experiment. If you had invested $1,000 in Nvidia 5 years ago, that position would have multiplied many times over. Not because it was just another tech stock, but because it sat right at the center of a megatrend: AI infrastructure. That's the key distinction. You weren't just buying a company, you were buying into a structural shift. And here's where it gets interesting. AI doesn't just need chips. It needs electricity, substations, transmission lines, cooling systems, water treatment, fiber networks, and physical data centers. That's serious infrastructure. Meanwhile, the world is already facing a massive infrastructure funding gap, hundreds of billions of dollars per year, meaning governments simply don't have enough capital to modernize grids, water systems, and transport networks on their own. So the AI build-out runs straight into that gap. It's increasing demand for infrastructure at the exact moment infrastructure is already underfunded. That tension is what creates bottlenecks. And here's why it matters for your portfolio. Value doesn't spread evenly during a bottleneck. It concentrates in the companies that control scarce capacity: power access, grid connections, urban land, water rights. If you own the bottleneck, you set the price for everything flowing through it. This is the core of today's AI investing trends. The winners aren't just AI companies, they're the businesses controlling scarce infrastructure capacity. So the real question is, do you have a map of where the next bottlenecks will form and who's positioned to cash in? So how do you actually think about all this? You need a framework, a mental map, because without one, everything just looks like noise. I call it the Great Convergence thesis, and I believe it forms the backbone of a serious future portfolio strategy. The three forces, AI, climate change, and urbanization, aren't moving in isolation. They're colliding, and when they collide, they amplify each other. To make this practical, I break it into three buckets. The first is the infrastructure backbone. This is the physical layer: data centers, power grids, substations, transmission lines, water systems. If AI is the brain, this is the circulatory system. The second is adaptation and energy transition, what many investors now call climate change impact investing. AI drives up power demand. At the same time, climate pressure forces cleaner generation and more resilient systems, not just reducing emissions, but funding the infrastructure required to keep economies functioning under climate stress. The third is urban density and efficiency. AI deployment happens close to people. Urbanization concentrates demand, and dense cities need smarter logistics, smarter meters, and smarter buildings. Now let me explain what I mean by inference, because this is important. Early AI was largely about training massive models in centralized hubs. The next phase is inference, when those trained models actually get used in real time. Think of the chatbot answering your question, the robot guided by AI, or the system helping navigate your car. That deployment happens much closer to where people actually live and work, the urban edge. And that shift changes where value goes. The early AI wave rewarded chip designers and centralized compute providers. As adoption matures, value moves toward infrastructure operators, power providers, and urban deployment platforms. So the question question becomes, how do you systematically identify who's positioned to capture that next wave? Because not every company with exposure to AI, climate, or urbanization will win. Some will benefit from rising demand. Others will get squeezed by higher costs, tighter regulation, or sheer capital intensity. That's exactly why you need a filter, a simple scoring framework built around 4 criteria: power demand leverage, urban density exposure, ESG materiality risk, and cash flow stability. The goal isn't complexity, it's clarity, because once you have the map, you can start validating it with real evidence. Up until now, we've been building the map. Now let's put that map to work. We'll look at real infrastructure and real companies, because for investors, a thesis only matters if it shows up in cash flows. If AI is the brain of the new economy, infrastructure is the body. And bodies need energy, circulation, and constant maintenance. Let's start with the energy. And nowhere is that more visible than in data centers. Companies like Equinix and Digital Realty aren't simply renting out server space. They control power access, grid interconnections, cooling systems, and physical proximity to urban demand. That combination is what makes them strategically critical. As AI shifts from centralized model training toward distributed inference, compute has to move closer to users. That drives demand for what's called edge capacity, smaller, strategically placed facilities inside or near major cities. But here's the key constraint. It's not space, it's power. Many of the most valuable data center markets are already power constrained. That means operators who have secured megawatt capacity and strong utility relationships hold real pricing leverage. When power is scarce and demand keeps rising, contracts get stronger, not weaker. That's bottleneck economics playing out in real time. A body that burns through energy inefficiently doesn't last long. The same logic applies to AI infrastructure, which is why performance per watt is becoming one of the most important metrics in the industry. Now let's look at NVIDIA. The early AI wave flowed to chip designers because they enabled the training boom. But as electricity costs rise and sustainability pressures build, a new metric is becoming strategically important: performance per watt. If your chips deliver more output per unit of energy, you're lowering operating costs for data centers while also reducing carbon intensity. That's where AI economics and climate economics start to overlap in a meaningful way. So the real investment opportunity here isn't simply AI stocks. It's aligning with structural AI investing trends, infrastructure-backed cash flows, secured power capacity, and efficiency gains that compound as adoption scales. Now here's where the body metaphor gets even more relevant. Because AI doesn't just sit on top of the energy grid, it stresses it. Every new data center, every inference cluster, every electrified building adds load, and that load is hitting an energy system that was never designed for exponential digital demand. This is where climate infrastructure stops being a nice-to-have and becomes mission-critical. Think of the grid as the industrial backbone of this whole system, the circulation network that everything else depends on. It now has to handle more electricity, more renewables, more volatility, and increasingly localized demand from data centers. And it needs to be rewired fast. That's where companies like GE Vernova and Quanta Services come in. GE Vernova provides turbines, grid solutions, and electrification equipment. Quanta Services actually builds and upgrades the transmission lines and substations that make it all possible. The bottom line for investors: you can't scale AI without scaling transmission. That dynamic creates long-duration project pipelines, regulated returns in many cases, and multi-year backlog visibility. This isn't speculative demand, it's contractual. But the grid isn't the only system under pressure. Add another constraint: water. Data centers need cooling. Power plants need cooling. And as urban density increases, water stress compounds. That's where companies like Xylem and Veralto become relevant. Water analytics, filtration, leak detection, quality compliance. As regulation tightens and scarcity grows, pricing power shifts toward whoever provides the solutions. And then there's the question of stability. More renewables on the grid means more intermittency, supply that fluctuates with the sun and wind. Battery storage systems, optimized by AI platforms like STEM software, help balance that intermittency and absorb peak demand spikes. The bigger AI gets, the more valuable grid flexibility becomes. So climate adaptation isn't a separate investment theme from AI growth, it's the enabling layer underneath it. For investors, that reframe matters. You're not just betting on decarbonization, you're positioning around the infrastructure that keeps the digital economy functioning. So we've covered AI infrastructure, power, cooling, and storage. Now we move to the third force in the convergence, urbanization, and the urbanization market opportunities it creates for long-term investors. Urbanization isn't just population growth, it's capital concentration. And wherever capital concentrates, infrastructure intensity follows. Because AI doesn't operate in a vacuum. It operates where people, businesses, and logistics concentrate. And density does two things at once. It multiplies demand, and it creates efficiency loops that make infrastructure investment more attractive. Think of it in layers again. The first layer is physical logistics. As cities grow and e-commerce expands, the demand for strategically located warehouses and distribution hubs keeps climbing. Companies like Prologis own exactly that. High-quality urban industrial real estate in locations where land near major population centers is genuinely scarce. And scarcity, as we've seen throughout this thesis, supports pricing power. There's another angle here too. Urban logistics infrastructure, power connections, fiber networks, distribution hubs, tends to cluster geographically. That means it also supports data center expansion, tying this layer directly back to the AI build-out we covered earlier. The second layer is smart infrastructure at the urban edge. As cities densify, managing electricity and water efficiently stops being a nice optimization and becomes an operational necessity. Companies like Itron provide the smart meters and grid edge intelligence systems that help utilities do exactly that. Efficiency at urban scale becomes mandatory. The third layer is premium urban real estate. Companies like Cousins Properties focus on high-growth Sunbelt markets where ongoing corporate migration is driving sustained demand for high-quality office and mixed-use buildings. Urbanization drives concentration. Concentration drives infrastructure intensity, and the companies positioned at those dense nodes are sitting right in the path of that structural flow of capital. Now let's slow down for a moment. Because whenever you hear multi-trillion-dollar megatrend, your first instinct as an investor should be to ask, where could this go wrong? Start with the short-term risks. AI valuations can overshoot reality. Markets have a tendency to price in perfection. If revenue growth disappoints or expectations get reset, multiples can compress quickly. Then there's policy and rate risk. Infrastructure is capital-intensive, and higher financing costs can delay or derail projects that looked compelling at lower rates. And in certain markets, data center overcapacity is a real possibility if build-outs run ahead of actual demand. Zoom out further, and the risks don't disappear. They just change shape. Power bottlenecks could limit expansion. Water scarcity could invite tighter regulation. And execution risk is always present. Some companies will overpromise and underdeliver. This is where a lot of investors make a critical mistake, confusing narrative with cash flow. Speculative AI exposure and infrastructure-backed revenue are not the same thing. A data center operating on long-term contracts looks nothing like a pre-revenue AI startup, even if both show up under the same AI theme label. So how do you protect yourself? Through deliberate diversification. Maintain allocation to high-quality fixed income. Include value-oriented equities with stable earnings. Balance your growth exposure with income-producing assets like REITs. And then run every position back through the scoring grid. If a company can't hold up under stress, weak cash flows, heavy leverage, no pricing power, it doesn't belong in a portfolio built around structural themes. The goal here isn't to avoid volatility, it's to own durable bottlenecks that can survive it. Now, let's bring it all together. We've mapped the convergence. We've validated the infrastructure layers. We've stress-tested the risks. So how do you actually translate all of this into a coherent future portfolio strategy? Think of it in 4 components. The first is the infrastructure core, your foundation of stability and long-duration backlogs. Grid builders, transmission operators, essential water infrastructure providers. The goal here is durability. Companies with multi-year project pipelines, regulated returns, or assets that are simply too critical to replace. The second is data centers and compute, your growth and pricing power engine. Data center REITs and compute leaders benefiting from rising inference demand and secured power capacity. This is where you capture structural growth as AI adoption continues to scale. The third is urban and water exposure, your scarcity and density play. Logistics, real estate, smart meter platforms, water technology companies positioned in high-density markets. Urban concentration supports recurring demand, and that makes these positions relevant over the long term. The fourth is your defensive allocation, the shock absorber. High-quality fixed income, value-oriented equities, assets that stabilize returns when growth expectations cool. In practice, a framework built on these 4 components might look something like this: 40% infrastructure and grid, 30% data centers and compute, 20% urban and water, and 10% defensive assets. That's not a prescription. It's a template. The point is balance. At the end of the day, the great convergence isn't about chasing hype. It's about recognizing where AI investing trends, climate change impact investing, and urbanization market opportunities intersect. It's about identifying the bottlenecks where capital must flow and positioning yourself there before the crowd fully prices it in. Investing well is really just thinking clearly about where the world is heading and getting there early. That's what we try to do here at Sketching Finance. If you found this useful, subscribe so you don't miss what's coming next. And drop a comment letting us know which of the 3 layers interests you most: infrastructure, data centers, or urban and water. Your input will shape what we cover next. See you in the next one.